All right, man, that 10-year yield has come down. 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, after 2 years of blowout earnings, NVIDIA delivers good but not great results, drawing a muted response from investors.
Investors also wading through a fresh batch of economic data. Next up, the January PCE report due out tomorrow.
Plus, we've got a trio of C-suite conversations with the CEOs of Celsius, Norwegian Cruise, and private credit giant Ares joining the show. All of that and more coming up, but let's take a look at where markets are trading. We just got some interesting news out of the Trump administration that tariffs on Canada, Mexico, and China are going to go into effect on March 4th. You can see the reaction in markets. We had been up much higher on the S&P 500 in futures, but pairing those gains right now, currently still higher by about 0.3%. You do have the NASDAQ 100 higher by about 0.6%, leading gains right here. It was a pretty muted response to NVIDIA, but still enough to lift the shares and still enough to lift some of the clouds hanging over your big tech benchmark. Then you take a look at the 10-year yield. Levels here are more exciting than the actual moves because we're talking about just a 3 basis point rise when it comes to the 10-year Treasury yield. But Matt Miller, you were gone for 2 days and bond markets rallied.
I left at 450, 460, and we're down like 20, 30 basis points.
There you go.
It's surprising to me that we're looking at gains in futures with that and the NVIDIA kind of ho-hum. Take a look at this. This is not Treasury yields, but if I did overlay the 10-year Treasury on this chart, it would look very similar. In fact, I may do that at some point today. This is the Citigroup Economic Surprise Index for the U.S., and it's down to levels lower than we've seen since September. So it does look like the economy is turning over. Maybe it's a growth scare that's been weighing on those yields. Yeah,
you brought back the excitement. There was a stretch of bad days. Welcome back, Matt Miller. Let's take a look here under the hood here. Look what's happening at the Magnificent Seven. Is being dragged higher, actually, by NVIDIA, not equally. NVIDIA, though, is up 2% pre-market. Remember, we have been saying it beat estimates. Guidance, though, is mixed. You can see that reflected in, as Matt said, a ho-hum share move. Snowflake, though, also delivering on a strong sales outlook and added features to AI offerings. Snowflake soaring, up about 14% pre-market. Salesforce, not as good, 2.4% lower. They said revenue from its new AI product, Agentforce, will be modest this year. Analysts see overall guidance as conservative, Matt.
Yeah, conservative guidance is not what I expected from Jensen Huang and NVIDIA. Like, if the market says, we think you're going to have $43 billion in sales this quarter, he's supposed to come out and say, it's going to be $53 billion. And that didn't happen.
I mean, he used a lot of exciting adjectives. He said that demand, this ramp up for Blackwell has been amazing, but I mean, maybe it's a new strategy to sort of under-promise. You saw a note out from UBS saying that we think guidance yet again leaves considerable room for upside. So we'll see what the conversation is in 3 months' time.
I think the sad part about this, too, is if you look at NVIDIA on the year so far, the move you're seeing might not even pull it out of red territory for the year. So pretty muted, well off the highs. This wasn't enough. And want to point out Bloomberg Intelligence as well. They were saying that strong Blackwell commentary and $11 billion in unit sales are likely to ease concerns, though the lack of major new near-term catalysts may limit additional excitement, which is a good place to bring in our own Caroline Hyde, of course, co-host of Bloomberg Technology. Additional excitement. Does NVIDIA need to be something besides just Blackwell at this point in the story for investors to start to latch on?
Well, he's already talking about Blackwell Ultra, bringing on what's happening in the second half of the year. He's then pointing about GTC, which is their big event, a week-long event of announcements and the latest and greatest in technology that comes up in March, saying you've got to wait with bated breath. We're going to tell you what the next innovation is. This is a company that acts more like Apple in terms of seasonality of upgrades. We've got every single year a new, very sophisticated, very difficult to get out into the masses supercomputer coming on deck. That is why you saw margins hit, for example. I think some of the fly in the ointment here was the fact that margins were about 71% in terms of the guide for the first quarter. And I think people are worried, therefore, about the fact that Blackwell, as it ramps, you need cooling technology. You're making this customized. You're in many ways using different networking gear. It's costly. So the CFO, Colette Kress, was really spelling out, this is why you saw a hit to margins. But then they're up and away. We have got the fastest ramp in history, and Blackwell is back out and being profitable. 11 billion blew people's minds, but it therefore meant that maybe that 43 billion guide for the next quarter was like, oh, are you not still managing to ramp up at the time? Does that speak to perhaps pullback in Hopper money coming through the previous generation?
So 11 billion in Blackwell sales, they said the fastest ramp up of a new product in their history. Because we should put that into context, right? Other companies have absolutely blown that away in terms of new product sales. When Apple released its iPhone 16, they had $69 billion in sales.
That's true.
And they continually, like every time Apple releases a new iPhone product, it has more than 50 billion in sales.
But you've got like 7 billion people on the planet who could potentially be a total addressable market for phones which are far less sophisticated in terms of making a chip. There aren't that many people who are going to be buying these chips, but they are incredibly sophisticated and expensive.
At least for right now, who knows how this will develop. Maybe we'll all need our own chips designed by NVIDIA. But this was, of course...
I ain't got the money for that. I don't know about anyone else.
Well, let's talk about DeepSeek and what Jensen Huang had to say about DeepSeek. This was their first earnings release since we had that scare. And the existential question there was that maybe we don't need a Blackwell. Maybe we don't need a Blackwell Ultra. Maybe we can do it with these less powerful chips. What did Jensen actually have to say about that?
I think he's done a very good job at steering us to this new scaling law, which is reasoning models. And the idea that these kinds of models in the longer term, he thinks might take even more compute than they had factored in. He's really trying to point out that as we move from training models to inference, this is still going to need their sophisticated technology compared to other people's.
All right, Caroline, great having you dip into our program for a little bit.
Sorry to be mean about the iPhone.
No, that's fine.
Good. That's good.
Look,
That
the
needs
thing
some
is,
context.
I use Blackwell chips on my iPhone, right? Because I'm on ChatGPT constantly. So
Well said.
they should, at some point, catch up to Apple. Caroline Hyde is going to have an amazing program today. Not only will they focus on Bloomberg technology on NVIDIA, they will also focus on Amazon with the CEO. Andy Jassy joins Caroline at 11 a.m. Eastern, so that's a do not miss interview. Let's talk more about what NVIDIA means for markets today with Morgan Stanley Wealth Chief Investment Officer Lisa Shalett. Lisa, great to get your take on this and really the AI issue post DeepSeek. We've looked at Magnificent Seven stocks as a group drop more than 5% year to date, and NVIDIA just really hasn't helped. Are we not as pumped about AI in 2025 as we were in 2024?
I think you hit the nail on the head. I mean, look, if you look at the chart in NVIDIA, as the point has been made, the stock has basically been flat for going on, 7-8 months, nowhere near its all-time high. And so I think, this investors understand that these, hyper growth stories mature, and you get to a point of the law of large numbers where some of these growth rates are inevitably going to decelerate. I do think that the DeepSeek news was a wake-up call, less about DeepSeek per se, but more about the reality of how tech innovation in a capitalist world works. Whenever you have a company like NVIDIA that represents a fundamental bottleneck and is earning monopolistic rents like 80% gross margins, you have massive numbers of engineers around the world working to innovate competitive chips, competitive processes, competitive ways of reducing cost, reducing energy consumption, and quote unquote going after the gold at the end of the rainbow. And I think that people get it. And so I think, that, certainly NVIDIA and, Jensen are extraordinary companies and an extraordinary CEO and leader. And he's been a poster child for accelerating the speed of innovation, and that's inspiring, certainly. But I think folks understand that it is entirely likely that sometime over the next year or two, we're going to see lower cost, faster, lower energy consumption processes, competitors, chips, ways of putting large language models together that continue to slow the growth here.
Lisa, I want to talk about the implications here for the broader tech sector. I want to pull up the Magnificent Seven in particular because you're watching every single stock besides Meta in this Magnificent Seven on the year in the red heading into today. Now, some of this might turn around. Nvidia might finally get back into the green on the year, but realistically, if you have that kind of malaise out of investors putting money to work in the big tech giants, then how much does that attitude spread, particularly when you think about how much this group has held up the broader market?
So look, I think for the market cap weighted indices, of which this group has made up such a disproportionate and historic proportion, at various moments as much as 35 to 40% of the index and nearly 60% of the returns. I think for the market cap weighted S&P 500 index, I think that this break apart and stalling out of performance is a headwind. But that doesn't mean that there isn't money to be made in markets. And one of the things that has been very heartening to see is the breadth underneath the surface, the move towards new leadership, whether some of that leadership is coming from some financials, some energy-oriented companies, some software companies, some healthcare companies. Those are all very healthy and encouraging signs underneath the surface. And we still think that this can be a year where that churning under the surface can produce, returns of, 7 to 10% in the S&P 500. That's not a bad year. That's a normal year. And I think that that's one of the things that investors are going to start having to get used to. I mean, I know, you guys opened the program today looking at that economic surprise index. When you don't have the Fed and you don't have these big, dreamy secular growth stories carrying the day, and it's about fundamentals, which is the economic news, which is inherently volatile, you're going to have these ups and downs, and you're going to have markets that, quote unquote, have to grind it out. And I think that's what kind of year 2025 is going to be, especially against the backdrop of still very high levels of policy uncertainty and kind of the speed at which headlines are coming out of Washington.
That was your chart, Matt Miller.
Well, I mean, I showed the chart, and then my buddy Jay here messaged me the 10-year yield overlaid. So people are listening. Lisa's listening, and Jay is listening.
The sound is on. And Lisa, you were talking about that new leadership emerging from under the hood. New leadership also emerging from Europe. You take a look at the stock 600. It's up 10% on a total return basis. You compare that to the S&P 500. Not doing much, up about 1.5%. We've spoken to plenty of investors on this show who have said that that's basically a blip, that they expect that to reverse. But reading through your latest research, Lisa, it seems like you think there might be something to this.
Look, I do think that there are folks who are starting to say, hey, if there is a ceasefire, there is a foundational argument for a bull market in Europe that's underpinned by the potential for reconstruction spending, the potential for there to be significantly higher defense spending across Europe, where they go from 2% of GDP to as much as 3.5%, and where the pressure from the energy sector on inflation in Europe could be relieved, less so from Europe actually starting to buy Russian gas and oil again, but just from Russia's sanctions being lifted and Russia dumping, some of their capacity onto global markets, reducing global energy prices. So look, I do think that there is the potential we get to a more bullish case, a more structural bullish case for Europe. I don't think we're there yet. We have not advised our clients to to overweight there, but we're watching eagerly because that would be really exciting, to be honest. Europe has languished really, kind of for the last 15 years since the great financial crisis. Their banks are finally starting to show some, balance sheet stability and balance sheet strength. We've got an ECB that may, in fact, cut 3 or 4 times this year. That's more than the Fed will do. So there's reasons to be constructive, but we've got to see this ceasefire. We have to understand the terms of it. We have to understand, what the politics in Germany, France, and the UK are going to look like.
Certainly a lot of cross currents to work through, not just in Europe, here in the United States as well. Morgan Stanley Wealth's Lisa Shalett, we thank you so very much for joining us this morning. And coming up, more on NVIDIA and the chip sector. We're going to bring in analyst David O'Connor of BNP Paribas Exane for that. Stick with us. This is Bloomberg.
Let's take a look now at high interest, what's making headlines around the world. Goldman Sachs president John Waldron is joining the bank's board of directors. The move signals Waldron's continued future at the firm, which has been trying to retain its top talent. It's a rare elevation of a banker who is not the CEO to join the board of directors, so they like you, John. A child in Texas has died of measles amid a growing outbreak of the virus. It's the first reported U.S. death from the disease in a decade. 18 people have been hospitalized for measles in the Lubbock, Texas area, which has seen the worst outbreak of the virus in 30 years. This child was not vaccinated. And a Bloomberg scoop, sources report that YouTube star Mr. Beast is looking to raise $200 million in a funding round that would value his whole company at $5 billion. He's looking to expand both his packaged goods and media empire. Talks are still in their early stages. It's not yet clear who will invest or if they will do so at the target price, but it's pretty bullish. Mr. Beast. Katie?
Yeah, congratulations to you, Mr. Beast. Let's check on these markets, of course. We got those tariff headlines right before the show started. You can see shaking it off right now. The S&P 500 up about 0.4%. The NASDAQ 100 higher by about 0.8%. And a lot of that comes to what we're seeing in NVIDIA. Let's turn our attention back there now because BNP Paribas Exane equity analyst David O'Connor joins us. He has an outperform rating on NVIDIA with a price target of $170. Great to have you with us. You take a look at shares this morning of NVIDIA, currently higher by about 2.5%. But the options market had been pricing for a swing of 10% in either direction. So I think that really speaks to kind of the ho-hum nature of this report that we were talking about. What do you make of the numbers we got on the look back and also the guide ahead?
Yeah, sure. Thanks for having me. Well, for us, I think there's 3 really critical things that we take away from the results. The first thing, was the strong numbers. The Q4 was 6% beat. That was reassuring. The guide maybe just a slight beat versus consensus. Again, maybe not as bullish as more buy-side expectations, but still it kind of helped steady the AI ship, so to speak. Margins may be a bit lighter as well. Maybe that kind of was a bit of a wrinkle there in the numbers. But again, we're at the start of a new ramp up on Blackwell. And, that's to be expected at this stage. But it is the trough Q1, and it should improve from here. So I think they tick the box for us on the number side of things. The second thing I think which is important is on the supply side. Ever since Blackwell ramped, we have had a lot of smoke signals out of the Asia supply chain regarding overheating issues, some packaging concerns, connectivity concerns. So they need to come out with a reassuring message, I would say, on supply. And I think we got that last night. They talked about $11 billion revenue on Blackwell. They had guided the kind of street to a couple of billion, say 3 to 4 billion. So they certainly kind of delivered on that, on the ramp up. And also, management last night talked about feeling a lot better right now on the supply situation versus they did in CS in January. So I think on the supply side, we took away quite a reassuring message in that front. And maybe the last thing was just on demand. I think ever since DeepSeek launched, maybe 3-4 weeks ago now, there has been a lot of investor anxiety around the sustainability of hyperscaler spending, and they really need to address that on the conf call. And they talked about DeepSeek actually being an accelerator for the business.
I want to go back to what you said on margins. I'm a numbers person. I only believe what I could see. And if you think supply is going to ramp up, at what point does that ramp up start to erase any concerns about margin pressure, such that they're bringing in more money than they're putting out the door?
Well, look, we're at the start of a Blackwell ramp up. It's a new product for a new phase of AI. This whole reasoning models, new test time compute. I mean, they spoke at length about it last night, where you need this 100x more compute versus previous generations of inference. So, the numbers tell one thing. The numbers really are a reflection of kind of what was ramping last generation with Hopper and the start of this Blackwell. So I think, numbers have to, they have to be solid. They have to be kind of going directionally correct in the right, up and to the right. But I think the commentary is more important here than the, and as you talked about, on the supply side, on the demand side, that's the most important thing here to support those kind of more bullish consensus estimates as we look through the back half of the year.
David, the regulatory borders have been pretty leaky, right, for NVIDIA in terms of its products getting into China. And surely this administration is going to be unhappy about that. So how much will they have to really comply? And how concerned are they about tariffs, considering the fact that the lion's share of their product is still made in Taiwan?
Yeah, sure. Some good questions there, Matt. I mean, look, the geopolitical situation is getting more difficult, not just for NVIDIA, but for all companies across the semiconductor space. But again, you have to look through the lens of, look, we are in a new paradigm shift here with AI. And there's a lot of startups, a lot of enterprise out there working on AI. And typically the industry, in my experience, finds a way to kind of get access to that capacity. And we don't see that as a kind of impediment to kind of the NVIDIA demand here, and certainly some of those growth forecasts. Right. So we're pretty bullish still on the demand, regardless of kind of the tariff backdrop. Obviously unhelpful, but it is what it is.
Let's talk about how the stock is trading, because you take a look at a longer-term chart, pull it out to 1 year, and you can see that really we've been range-bound on NVIDIA shares since about June. We're pretty much unchanged from those levels. Your price target is $170. We're at $130 right now. Are these factors, these potential tailwinds that you're anticipating, enough to push us there over the next 12 months? What do you think will really be the driving catalyst? Yeah, some great question. I mean, if we look back over the last couple of weeks, we've seen a big unwind in the in technology, positioning of investors within technology. They've been concerned, as we talked about, they've been concerned about DeepSeek. They've been concerned around that sustainability of hyperscaler CapEx spend. And I think, NVIDIA goes a long way towards, to steadying the kind of that AI kind of outlook. Look, in the end of the day, NVIDIA is the AI bellwether. It's driving the bus here on AI, and all the passengers here in the supply chain in AI, they will benefit and take their lead from NVIDIA. So I think, we've ticked the first box this, last night with the results. And I think, if we look over the catalyst for the next couple of weeks, we're going to get some more results from the likes of Broadcom, Marvell coming next week. I think also you'll have some of these hyperscaler management teams on the road in the next couple of weeks, and they will be out there pounding the table on AI, convincing investors that, look, this the secular adoption of AI remains on track. And I think that's investors need to hear that to kind of reverse this. Reverse what we've seen on the technology, the risk off on technology for the last couple of weeks since DeepSeek launched.
David, we thank you so much for joining us here on set. That is David O'Connor of BNP Paribas. Pounding the table is what these companies have to do. If you look at the S&P 500 versus the SOX, while on a 5-year basis, the Philadelphia Semiconductor Index has outperformed. To Katie's point, it's been weak. And Broadcom, Marvell, some of the companies reporting next week, some of the weakest in that group. NVIDIA has also been sluggish. It's actually the companies that hadn't been doing so well, like Intel, that are at the top.
All right, we'll wrap it all into the market open. Coming up next, less than 4 minutes to go until the bell, we'll discuss what's going on with JPMorgan's Paul Quinsee. Don't go anywhere. This is Bloomberg.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. Markets undeterred by the absolute meh of NVIDIA earnings and really the outlook. S&P futures up 0.4%. Even a tweet on tariffs doesn't deter investors from buying futures. NASDAQ futures up 0.8%. Russell 2000 unchanged. At the New York Stock Exchange, Primo Brands ringing the bell, and it's a Primo stock up 150% in the past 5 years. They make like Poland Spring water and Saratoga and some of the other sort of sparkling waters that you probably buy a lot of. 8Co ringing the bell at the NASDAQ market site. Cool ticker, Octo, but it's only like a $3.3 million company after falling 99%. In 2022. Katie, what do you see in terms of the major averages this morning?
Well, I see a little bit of green, at least for right now, Matt. Of course, we had 4 straight days of declines, and then the S&P 500 theoretically snapped that, but it was pretty much unchanged yesterday. Now that we're past those NVIDIA results, you can see we're higher by about 0.5%. We do see a little bit more lift when it comes to the NASDAQ 100, higher by about 0.8%. It was a ho-hum report, but it did what it needed to do in terms of maybe reversing the direction of travel. I can't say the same for the Russell 2000. You take a look at the small stocks in this market right now, pretty much unchanged, really have been just brutalized over the past couple weeks. But at least for Russell 2000, at least for right now, the color is green. Let's take a look under the hood and get back to the story of the day, and that is NVIDIA. That mixed outlook really being reflected in the minor moves that we're seeing in the stock currently. Analysts were largely positive on the report, but margins were singled out as an area of relative weakness, which is amazing because we're still talking about a 7 handle. But you can see that some of those pre-market gains being brought back now. Shares only up about 1%, Sonali.
And Katie, I've got another AI story for you over here. Snowflake is rising on a strong sales outlook. It also announced an agreement to let customers access OpenAI models directly through its system. Snowflake up the most since November, up more than 12% at the market open, and also erasing some of the losses for the year. Matt, this has had a tough year and a very good day.
Snowflake. Salesforce revenue rose 7% in the fourth quarter, but guidance is not impressing investors. It's uncannily like NVIDIA. It says revenue from its new Agentforce product, the AI product, will be modest this year, but meaningful next year. So pushing ahead with the monetization. Let's take a closer look at NVIDIA with Bloomberg Intelligence senior semiconductor analyst Kunjan Tabani. Kunjan, NVIDIA, we just heard, beat by 6%. That doesn't really feel like Jensen Huang, right? They only forecast sales for this quarter in line with expectations. Aren't they supposed to crush it and raise?
Well, yeah, like you said, we have gotten so used to them crushing it every single time that even a fantastic beat and raise compared to what's happening in the rest of the sector, we take it as a lukewarm reaction, and that's what you see in the stock.
Lukewarm is not a word you love to use when it comes down to NVIDIA. I understand that a lot of people buy the story, what is coming ahead, but I really do think numbers matter. If you see margins becoming a question, then don't you need to know, Kunjan, when that story is going to get better on the margin side?
Definitely. And I think the margin, sort of what came in below is being overblown. So if you think about it, the margins are lower because they are shipping more Blackwell than they and most of the folks on the street thought, which is actually a good move, according to us strategically, because we want them to get as much Blackwell out in customers' hand as possible, that they can always get back the margins. And that's what they have echoed, that they will get the margins back in the later half once the ramp is up there and they can then focus on cost optimization and yields.
I do want to talk about NVIDIA as it compares to some of the other chip names. And this is my favorite chart, at least of today. I'm talking about Intel versus NVIDIA. You think about Intel, it's just really been difficult to get off the mat. It had a terrible 2024. But year to date, it's one of the outperformers, up almost 20% on a total return basis. NVIDIA shares actually still in the red right now. Last night's results not enough to boost it back into positive territory. And Kunjan, it's not so much of a question, just more of a remark on this incredible reversal of fortunes, at least for the first 2 months or so of 2025.
Yeah, so there's 2 points of context that's important, right? When you look at last year, SOX was at about 25%, Nvidia maybe close to 200%, Intel was down about more than 50%. So where they're starting from is important. Second, I think the rally that you see right now is more of a relief rally around all the news and optimism that the company might get broken off, and some saviors might come and take over pieces, and basically that would result in a better shareholder return because currently the company is more valued broken off than together.
All right, Kunjan, really appreciate your analysis. As always, that is Kunjan Sabani of Bloomberg Intelligence. And let's keep the conversation going now with JPMorgan Global Head of Equities, Paul Quinsee, joining us at the desk. Paul, it's great to see you again.
Thanks for having me back.
So let's go to this line in your note. You write that valuations matter. And I want to talk about this market through that lens, because not even just Nvidia and this comeback to earth that we've seen, but you think about how the broader indexes have been trading over the past couple of weeks. We've had fears about inflation, about tariffs, about what the trajectory of U.S. growth looks like. Should we be viewing this basically as a valuation reset?
So the reason I said valuations matter is I think this is the year in which investors will be well advised to remember a couple of the sort of time-honored principles that we all grew up understanding in the business, we all learned at school. Valuation matters. And the other is that diversification is your friend. And frankly, neither of those two have been much use to you in the last few years. We know markets have been incredibly concentrated, not just in the US, but around the world. Increasingly, the conversation has been dominated by a handful of stocks, one of which, of course, reported last night. By the way, I thought the headline that Nvidia posted, mixed outlook, is a little harsh. I mean, this is a company, remember, they're growing their revenues at 70% this year with roughly a 70% operating margin. This is one of the most successful companies of all time and remains so, and in our view still will be 3 years, 5 years from now. But the point is, that's just so much better understood now. It's in the price.
Yeah, I mean, it would be amazing if we didn't expect them, Paul, to grow revenue at 70%. Right. So, and that's what the stock market's all about, right? It's a discounting mechanism, and if everybody expects 100%, then 70% isn't going to be that great.
Exactly. Valuations matter, which is why I think looking for opportunities outside those 7 stocks we talk about all the time, and making sure your portfolio is facing forward and looking for the opportunities that have come, rather than just overweighting those that have worked so well. Even just a simple rebalance is an important thing to do. And I think a lot of investors are not doing that.
It's funny, Matt, I think you were not here this day. We were talking about the S&P equal weight. This is kind of my new favorite index to watch because it has performed pretty well, actually, particularly relative to the other broadening trades investors had tried to bite on, like the Russell 2000. It's just not. Sorry, it has not paid off.
Is that year to date? Is that S&P equal weight year to date?
This is 1 year. So if you look, it's not quite up and to the right. It
not
is
bad.
Not bad. So how do you feel about the idea of broadening? If you're trying to look outside the Mag 7, if you're trying to look outside of Nvidia, where do you look?
Yeah, so the broadening has to be driven by fundamentals, right? That last year, Magnificent 7 profits up 34%. I think the other 493 stocks in the S&P managed 4%. Of course you're going to invest in the Magnificent 7. Why would you bother with anything else? But this year, that picture changes. So the Magnificent 7 is slowing down a bit. They're getting a little more mature. They're spending all this money. That's weighing a little bit on, certainly on cash flows. And the rest of the market, we think, is picking up. That's the crucial point. And as we pass through the fourth quarter earnings, plenty of growth in the economy, plenty of growth in the corporate sector. But we are seeing, slowly, some signs of that broadening out. I think the home improvement retailers, a good example of that, right? So they've been in this kind of 3-year slump after the COVID boom. Home Depot and Lowe's said some better things about what's going on this year. It's coming through slowly. So you need the fundamentals on your side. Ultimately, investing is all about the fundamentals.
Right.
But I think also you can look beyond the US. So European stocks, which have been really something to avoid mentioning on TV or anywhere else for most of the last 15 years, have shown some signs of life. And while I wouldn't for a minute expect companies in the US in aggregate to grow as fast as the US, and we think the valuation argument for Europe is often kind of overstated. It's not as simple as 14 times in Europe, 22 times in the US. European companies are in slower growing industries. Their accounting isn't as good. They have a tougher macro environment. But there is some value there. And I think we've seen investors running from Europe for a long time. Our European clients have wanted nothing from us other than US equities or global equities, which is 70% US. That's kind of the same thing. I think it's an overlooked market. we think European earnings can grow about 9% this year, which is not as good as the US, but it's not bad.
Yeah, it's not bad. And it's funny, when this show started in July, I didn't want to talk about the Dow, and I didn't want to talk about any other stock market but the US. I still don't want to talk about the Dow, but I do want to talk about Europe more, because I was going to ask you to thread that needle between valuations for European equities and the fundamentals. We were speaking with Maria Waitman from State Street a week or two ago, and she said that, okay, maybe the valuation argument is there, but the fundamentals are just weak when you take a look at Europe. It sounds like, obviously, you're taking the other side of that trade.
A little bit. So, look, the US has outperformed Europe by 7% a year for the last 15 years. You compound that up, that's an enormous difference in the outcome. And if you analyze that 7%, about 5 percentage points of it is better earnings growth. At the beginning of that period, though, European stocks and US stocks are priced about the same, which in hindsight was a huge mistake. Investors are saying the same for Europe, slow growth Europe, as they were paying for US, with all the energy and the dynamism that we see here. But now you have this big discount, which at least partially reflects that weaker outlook. And then this year, we think earnings in Europe up around 9%. We've had 2 years of no growth at all, but currencies in your favor, some low base effects, and there have been some great investment opportunities in Europe that you don't want to miss. The financials, for example.
Well, I have a kind of a left field question on Europe. Lisa Shalett was mentioning that reconstruction could be a big boom to the European economy. And I've been thinking, if Trump really pushes this continent, this group of countries, which historically have had pretty weak military spending, to ramp that up, you know, to sell Euro bonds and fund a huge expansion of European military forces. Is that also a driver?
If that happened, then yeah, I think that's pro-growth and that's pro-equity and would be a good thing. Now, look, we've all learned forecasting politics, both in terms of what the policies will be and then what they will actually do, is a very dangerous game and a very difficult thing to do. So for us, it's stay focused on the fundamentals. But even without that kind of additional benefit, we think the fundamentals in Europe are reasonable and there are some attractive stocks. It's a great place to be a value investor. You know, value in Europe has been working for 4 years.
I love living there.
Take that Benjamin Graham book out of the trash can. It's time to wipe it off. JPMorgan's Paul Quinsee, we thank you so very much for your time. I like valuation math. And, you know, the funny thing about this is NVIDIA cheap or expensive? You look at it today, you're already watching the gains on the morning erased. It's early in the day, Katie.
Yeah, that is the big story in the stock market right now. NVIDIA reversing what was a 2.5% gain pre-market, now down about 1.4%. That obviously is your biggest weight on the S&P 500 right now, which overall is still positive. What's interesting to me, you talk about value. This isn't value, but NVIDIA's PE ratio is now 29. I mean, we were looking at 37 in the summer. Matt, you pointed out that we've been at 60 before, so we've halved that.
Relatively cheap.
Yeah, I'm starting to question these straight up PE ratios. I want to figure out how to do like Schiller PE on the Bloomberg. I'm sure somebody.
You should blog about this.
And tell me.
Open interest after hours.
Those valuations are much, much higher. All right, we're going to continue to focus in on this drop in NVIDIA shares and watch what it does to the broader markets. So far, we're still seeing gains of 0.4% on the Dow Jones Industrial Average.
What's that?
43,620.
Almost meaningless.
Never heard of it.
Still something.
This is Bloomberg.
Welcome back to Bloomberg Open Interest. A check on the stock market right now. We were just talking about NVIDIA erasing its gains. The S&P 500 still holding on to its gain. Can't say the same about the NASDAQ 100, giving up its leadership, still in the green for right now, but you can see those gains being paired. The Russell 2000 also deepening its sell-off. NVIDIA obviously is not in this index, but it seems like those small cap traders looking for a reason to sell here. Let's get to our top calls. Some of the analyst action in focus this morning. And first up, we have Constellation Brands no longer a buy over at Morgan Stanley. The Corona maker getting downgraded on long-term beer concerns, down about 3.3%. Next up, we have Goldman Sachs, also no longer a buy over at KBW. It's getting downgraded because of uncertainties around tariffs, inflation, and interest rates, but this stock hit an all-time high earlier in this month, so they're doing okay. And finally, we have Checkpoint Software getting upgraded to a buy over at JPMorgan thanks to positive growth trends. Shares up about 0.6%, Matt Miller.
All right, very cool. Checkpoint up although only 0.6%, better than a stick in the eye. Some more of the movers that are on our radar this morning. eBay sales for the current quarter miss analyst estimates because of soft demand in Germany and the UK. So eBay down, well, decimated, really, down almost 10%. JM Smucker with optimistic guidance as higher sales of Uncrustables help to boost revenue. This
Have you
is
ever
like,
had those?
Have you ever had them?
I sure did.
I love Uncrustables.
Gotta be honest, they're great when they're kind of frozen still.
Yeah, I love them even now as an adult woman.
too.
I just think they're great. They're easy, and it's been a big boon for James Smucker.
I would like to try. I would like to try
You can
one.
get them at CVS behind lock and key. You just have to fight your way into the freezer.
And then we saw Moderna. Well, it's interesting that it's down, right, Smuckers? We see Moderna also down as the White House reevaluates a $590 million contract for bird flu shots. Maybe they want a cheaper price.
Yeah.
Maybe they don't believe in vaccines anymore.
An interesting time to reevaluate this contract. We know that there's plenty of fear about the bird flu right now, and we just spoke to Zoetis that getting a conditional license as well. But Moderna obviously moving big time on that news. I will say for JM Smucker, just to go back to that, Uncrustables, a real bright spot, but they reported a drop in sales in coffee and dog snacks. So there you go.
Maybe dogs are going healthier. I know I don't let my dog eat snacks anymore.
I'm giving my dog less coffee, so all that is bad news for JM Smuckers.
All right, let's get to NVIDIA. Those shares, as we showed you just a few minutes ago, turning negative in this market, now down a little bit more than 1% after, I won't say disappointing with an outlook, because I think the street was looking for an average of 42.3 billion. And they did beat that with their forecast for the fiscal first quarter at 43 billion, but there were estimates as high as 48.
And Paul Quinsee telling us that we're being too harsh, basically calling this mixed results, but it seems like the entire market disagrees with him.
We're like 13% off their highs. So my question is, at what point is it a buying opportunity once again?
Especially with those PEs
Where are
that
the
Matt Miller
buyers?
doesn't care about.
That's a good question. I do care about the PE, but I'm looking at the CAPE ratio. I'm studying that on the Bloomberg terminal. Tom Keene is going to help me out during the break. Coming up, two Wall Street titans are teaming up for a highly anticipated ETF. We'll bring you the details, and this is really exciting, I think, in today's Wall Street Beat. We're going to talk about private equity in a fancy new wrapper. This is Bloomberg.
And it's time now for the Wall Street Beat. Today we are looking at the much anticipated debut of the private debt ETF from Apollo and State Street. It is the first one to reach the market, and it will test the limits of investor appetite for one of the hottest areas of finance. It's set to trade under the ticker PRIV. Joining us now, Eric Balchunas, Bloomberg Intelligence Senior ETF Analyst. You know, it's hard, Katie has been pointing out to me earlier, it's going to be hard to figure out the reaction from early trades, really. But this has the potential to change two industries pretty drastically. Apollo started a trading desk in order to make markets in private investment grade debt to help facilitate making this market more liquid. But do you still see any concerns around liquidity if things go bad?
Yeah, that's a big concern, right? There's the fund, as you said, it's really a trailblazing fund because prior to this, you could only have up to 15% in illiquid securities. With this, you can go up to 35 and even more. There's some fine print in there. So this is going further than any ETF has gone. And they solved that by using Apollo, and the SEC was okay with that. But yeah, if there's an illiquidity issue, right, I will say, I think this ETF should be considered a hybrid. It's like mostly ETF, but maybe a little closed-end fund. But here's the thing. We've seen this happen before. EM had a problem with the Russia stocks that it owned. They got illiquid. The EM ETFs traded on. Their arbitrage band stretches a little bit, but they still trade. And my opinion is ETF investors have been accustomed now for years to occasionally having stuff that goes illiquid inside the portfolio. The ETF trades on, and they understand that the percent premium discount will stretch a little bit. Right. So I think the market's going to be comfortable with this. The question is, will they want it? Private credit versus private equity. How much will it return? I think those things matter too.
Yeah, absolutely. And I mean, you make a great point that we've been in similar situations, and some of the illiquidity doom loop sort of warnings I'm seeing kind of remind me of what we have seen in traditional fixed income as well. But obviously, like you said, this is trailblazing, so we'll just have to see. I want to talk to you about the regulatory angle. There's a lot of surprise out there. I'm sure you've seen it as well, that this was even allowed to launch. We are in a brave new world when it comes to regulation. And what do you think this says about this new SEC's willingness to let innovative products, if you want to call them that, come to market, especially when you think about what's going on with crypto right now?
Yeah, this and a couple things that happened in the altcoin filings, to me, have signaled this is going to be a much more lenient SEC. If you've read Hester Peirce's comments on several different issues, she's libertarian. She thinks, look, let innovation happen. Just disclose, 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 and let the customer decide. That's the capitalistic market we live in. Gensler was a little more like, a little bit more nannyish, to be honest. So here we're going to have, I think, a lot more products that come to market. That's going to make me have some job security because we're going to have to vet these products, explain the risks and whatnot. But overall, I think you're going to see a lot. Brave New World's a good way to put it. We talked about, we could see over 1,000 launches this year.
Wow.
We could see ETF share classes, altcoins. It's going to get pretty wild. And this one is, to me, a trailblazing ETF that it could start a whole new category of all kinds of illiquid instruments in ETFs.
Eric, we thank you so much for all of your analysis. That is Eric Balchunas of Bloomberg Intelligence. Now, I'm heading down to Ares for a series of exclusive interviews, including CEO Mike Arougheti in the next hour. We'll miss you guys on set, though you have some amazing interviews, including the CEOs of Celsius, as you know, I love Celsius, and Norwegian Cruise. They're all joining the show. Stick with us. This is Bloomberg.
We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak will be back with us later this hour.
Coming up, signs of a resurgence in inflation are everywhere. We'll discuss the impact on consumers with top economist Michelle Meyer.
We'll also get insight from the C-suite on the consumer, the CEOs of Celsius and Norwegian Cruise joining us this hour.
Plus an interview with private credit billionaire Mike Arougheti of Ares. That's where Sonali went, so she's going to bring us that exclusive conversation down the line via satellite later this hour. Really excited to hear what Mike has to say.
All right, all that more coming up. Let's get a check on these markets, which are moving fluidly right now. The S&P 500 flipping into negative territory and then some, now down about 0.5%. The NASDAQ 100 even more so, down over 1%, and that's because NVIDIA losses deepening, currently off by about more than 4%, actually, Matt. A big reversal from what we saw in the pre-market, and you're seeing that in the indexes. That is your biggest weight to the downside on both of those. Meanwhile, the bond market pretty well behaved. You can see yields higher by just 1 basis point. We are well below 430, though.
Yeah, fascinating to me after spending 2 days riding Harleys in Texas to see the 10-year yield come down so drastically. Let's talk about why with Michelle Meyer, Mastercard Economics Institute chief economist. And I have so many questions for you about the consumer and, possibly pulling purchases forward on tariff concerns. But really, this 10-year yield is so fascinating. And I've been asking everyone I see with any connection to markets, why do you think it's come down? Is this, on hopes that the Fed's going to be able to cut as inflation is contained, or is it growth concerns as we see the economic surprise index disappoint?
Well, look, I think there's just been a lot of volatility in rates since the beginning of the year because of the uncertainty around fiscal policy and how that's going to interact with the overall economy. So if you think about earlier in the year, you had this big jump up in interest rates, the market pricing out the Fed, the view that deficit expansion was going to be inflationary, that in general, a lot of the policies out there would be inflationary, but at the same time wouldn't damage growth. It was this combination of views the market was pricing of stronger growth, higher inflation, deficit expansion, hence interest rates should go up. And now I think that we're actually starting to see some of these headlines kick in. We're learning a little bit more. Markets are understanding a bit more about the data, trying to snuff out a little bit from some of the soft data, the survey data. I think there's a little bit of a repricing. And my sense is it's probably not going to be over, right? We're going to continue to see some movement here.
Well, we saw initial jobless claims today come in at 242,000. I'm used to seeing this number always at 200 and teens, maybe 220s.
Yeah.
So, and that doesn't even count any federal workers who have been musked, right? So you've got that, and then the economic surprise index. I was showing our chart earlier, 2331. We can pull it up.
Yeah.
It's coming back down. So we're starting to see real softness, at least in terms of the indicators that we watch here at Bloomberg.
But look, I think so for initial jobless claims, we all know weekly data, noisy data. There was evidently some particular distortions in some of the states in the Northeast, Massachusetts, I think, being one when you look at the state level data. So let's see. Let's look at the next few weeks before we make a declaration around what's happening in terms of churn in the labor market. Because generally speaking, the churn in the workforce has been positive. The labor market has been a shining star for this economy, keeping the consumer going and keeping the broader business cycle expanding. So I think we still have a lot of monitoring to do in that front. But in terms of the economic surprise index, I think it goes back to the commentary around interest rates in the sense that there was a lot of optimism to start out the year. That was partly because of so much momentum at the end of last year, right? When we look at our own figures, it was a very strong holiday shopping season. Consumers were very active, spending across the board as at the end of last year, and that was continuing into early this year. And I think that was priced into a lot of those surprising measures.
Well, let's look ahead because I want to talk about inflation. NVIDIA, that's out of the way. That was the most important day of our lives. Now, inflation, when you think about the nervousness in this market, set to be have a lot of eyeballs on it.
Of course.
Where do you think we're going? I mean, you have all these growth concerns in the market, but you think about potential tariffs and inflation, at least from what we're hearing, is set to be pretty sticky, and recent data would bear that out.
Yeah. So I think for inflation, absolutely agree. It's very important. And what's important is not just the headline, but the components within the inflation metric. So we are seeing some upward pressure from the exogenous forces kicking in around bird flu impacting eggs, some other types of weather events impacting some raw material pricing. It's too early, of course, to see the impact of tariffs and any new tariffs that have been recently announced. And then services inflation more broadly, right? And particularly shelter inflation. Owner's equivalent rent has been the component that has proven to be the stickiest. It's a large share of the basket. It's believed historically, at least with economic models, to be influenced by the labor market, right? When you think about where that Phillips curve kicks in, owner's equivalent rent is one of the categories that it should kick into. And we still have a very low unemployment rate. So that's one element to watch. But then when you look at the goods side of the equation for CPI and PCE, goods inflation has been coming down. We've actually seen outright deflation for a number of categories within the goods basket. And I do think consumers have noticed that throughout last year, and that was very encouraging. Now, when you look at the surveys, they're getting concerned that that won't continue.
Yeah, well, that's exactly where I wanted to go. Where is the consumer right now? We've been reliant on this strong American consumer for so long. You mentioned the goods deflation, but weigh that together with what we're seeing when it comes to inflation expectations, which, as you note, have been on the rise. Yeah,
so the University of Michigan survey is definitely worth following right now when it comes to how consumers are expecting prices to fare going forward. And they have become more concerned given these headlines. But that's survey data, that's soft data that hasn't yet shown up in the hard data. So we all know from monitoring the economy for many years that those surveys can swing around a lot. The soft data can move pretty dramatically. So we have to wait to see what actually plays out, how that potentially, if there's an increase in import prices, how it passes on to consumer prices, which categories, and then how the consumer navigates that. Because one thing has also been very clear to me, studying the consumer since the post-pandemic period, is that the consumer has been very nimble in this environment, trying to find out the best place for value, shift their basket around. And I would imagine that's what's going to be occurring with the consumer if we do see these changes.
What do you see in the hard spending data?
Yes.
Obviously, you have a bird's eye view of that at Mastercard. I was talking to a guy yesterday who wants to buy a new car, and I said, man, you better get it now, right before tariffs. And my wife ordered like a case of maple syrup from Canada.
Smart lady.
Yep.
You know, to get ahead of that.
Get ready with those pancakes.
Yeah.
So, yes, a lot of people like you are being savvy in the sense of thinking about if it's a big ticket purchase or there's something that's dependent on exports. Maybe think about stocking up or purchasing in advance if that's possible. It's not possible for everybody, right?
There's a 3 dozen egg limit at Costco.
Well, that's a whole nother story. That's not, but yes, there is that. But I think when you take a step back and you consider the trend in spending, we're seeing on a trend basis from our spending pulse data around 3.5, a little bit higher in terms of year-over-year spending for retail ex autos. It's been quite strong at the end of last year, a lot of momentum heading into early this year. It could be partly a function of some pull forward. It could also be the fact that, again, real wages are positive. The labor market has remained strong despite some of the fears. So far, it's been remaining very supportive for consumer fundamentals.
Can you stockpile eggs? Is that a good thing?
Not according to you and Costco, right?
Well, I mean, you're not allowed to buy more than 3 dozen at Costco.
Yeah.
You have to get there before 10 because they're sold out of eggs.
Right.
After they, half hour after they stock them. But
yeah.
you can keep them in the fridge for a while, I think is Katie's question.
Yeah.
Right?
That's what I'm concerned. Listen, I can find a way to get some eggs.
I just told my kids there's just not going to be eggs for the next few weeks. You guys just move on.
We're in a brave new world on so many fronts. Michelle, great to get some time with you ahead of CPI tomorrow. PCE, rather.
Yes.
That is Michelle Meyer of the Mastercard Economics Institute. Meanwhile, we got to get back to these markets, and we have to get back to what's going on with NVIDIA shares right now. Now down 3% or so, not quite session lows, but it's dragging down the entire market. Let's bring in Mandeep Singh of Bloomberg Intelligence. Mandeep, we were looking at pre-market gains. We opened, things got a little bit weaker. Now we're looking at very clear losses. What is going on? What is this delayed reaction that we're seeing to last night's earnings report?
Well, so there was news around tariffs this morning, and the fact that China tariffs are going up by another 10% impacts a company like NVIDIA. And they were specifically asked last night about, the impact of China on their guide. And to my mind, the fact that their COGS, cost of goods sold, are clearly exposed to any tariffs that are imposed on China, that would impact their gross margin guide, which they said will rebound to mid 70%. But I mean, if you factor in the additional headwind from tariffs and probably China's sales going down because of more export controls, those two factors clearly are a headwind for NVIDIA.
We saw a tweet or a truth or an X or something from the president
on social media.
Yeah, saying that he's going to put an additional 10% tariffs on China. He's already put 10% tariffs, an additional 10% tariffs on them in February. So are you looking at how much this is going to actually hit? Can you quantify what we can expect in terms of the hit to their gross margin in this quarter and the next quarter?
Yeah, we already saw that this quarter was slightly below consensus, and at one point they were above, 75%. Now they are close to 71%. Although they did, guide to the fact that it will ramp up in the second half and it will improve. But the point about tariffs is, if their chips are manufactured in Taiwan, go to China, and then the end product gets shipped to the U.S., then in those type of instances, NVIDIA or anyone else who is shipping the product will have to pay tariffs. So it comes down to, how the supply chain is set up. But clearly, a lot of the NVIDIA chips come through the China route. And that's where I think there is definitely some exposure. It's hard to quantify whether it's going to be, 200 basis points or more. But in their guide last night, they said they haven't factored in the impact of tariffs or what happens to China sales.
Well, all of those big questions working its way through the stock price right now, down about 2% on NVIDIA shares. Mandeep, really appreciate you running to set. That is Mandeep Singh of Bloomberg Intelligence. Now, coming up, Celsius making a comeback. Shares of the energy drink company back on the rise after announcing a deal last week to buy one of its rivals. We'll speak to Celsius CEO John Fieldly next. This is Bloomberg. Well, Celsius is buying rival energy drink company Alani Nu for $1.8 billion. The cash and stock deal is expected to close in the second quarter of this year. Now, shares of Celsius have fallen sharply since its peak a couple years ago, but thanks, of course, to fierce competition, but have since rebounded on the news. Let's try to break it down now with Celsius Holdings Chairman, President, and CEO John Fieldly joining us on set. Great to see you in person, John.
Same, glad to be here. Exciting.
So let's talk about the logic of this deal. Obviously, it was met with a lot of positive reaction in the stock market, but what does Alani Nu add to your portfolio that Celsius couldn't do organically?
Well, what you see, these two brands last year in 2024 contributed over 50% of the category growth rate. They're bringing new consumers in. So when you think of traditional energy, more masculine, male, thrill seekers, it was, that's quite niche today when you think about the energy category. It's a $90 billion category. Celsius is fitness lifestyle, live fit, inspire people to live healthy and live life to the best and accomplish their goals. The Alani portfolio focuses on a female consumer. That's a growing segment within the energy category. Energy's gone mainstream.
Yeah.
In 2024, Celsius made it as a trademark, as a top 10 trademark in all of beverage, with some nostalgic brands that date back to the 1800s as well. So it's exciting.
Well, we were joking in the commercial break. It's too bad Sonali isn't here because she drinks a Celsius every morning.
She's definitely got one in her hand right now.
There we go. Love that.
So,
cheers.
So that segment of the female consumer market you've got locked down. But let's talk a little bit about how you make sure that, when it comes to Celsius, when it comes to Alani Nu, how do you make sure that you don't just cannibalize each other's sales, for lack of a better word?
Yeah, that's been a lot. There's been a lot of conversations around that. And, when you're looking at the category, we felt when we look at the Celsius portfolio, it's male, female, it's about 50-50, age neutral. With the Alani portfolio, it's Gen Z, millennial, female, really female focused, and it really is incremental. Looking at some Mintel data, and you look at the Celsius consumer, we have about a 14% crossover. So consumers that are purchasing Celsius are also purchasing Alani. It's about 14%. But we have a higher crossover with Red Bull and Monster. So this category is going to continue to grow. Health and wellness continues to get stronger. The category went sugar-free for the first time in history. And now, when you look at the energy category, over 50% is sugar-free, and Celsius and Alani have a huge runway of a sugar-free offerings.
It's funny, I never thought about the breakdown in target consumers until I saw The Guardian had a story that called Celsius the Red Bull for women.
Huh.
And I guess you're saying now it's a 50-50 breakup,
Yes.
clearly from Alani Nu from the video we just saw.
Yep.
That's aimed at women, but I can also now understand that, Red Bull and Monster, these are for teenage boys on YouTube, or what's the one that Jake Paul drinks at?
I'm so glad I don't know.
Would you consider acquisitions to go after other groups? I mean, is there a group that you want?
Well, I think there's opportunities. We want to leverage the public company and the infrastructure we built at Celsius. We did over $1.3 billion in sales with the Celsius portfolio, made it as that number 9 trademark in LRB, did $2.7 billion of retail sales. Retail sales were up over 22%. And the addition of Alani now makes Celsius, if you do pro forma numbers in 2024, it's a $2 billion company on a run rate. So this really allows us to leverage the vertical integration we did in 2024. We bought one of our co-packers. We have teams of over 1,000 strong now. Really allows us to compete at the highest level against those other brands, Red Bull and Monster, that have really a multitude of portfolios. Gives you additional pricing, promotional strategies as well.
By the way, John, I'm sure you did the math on this. How much do you save buying a brand that's established, like Alani Nu, versus just creating your own in-house, which surely, obviously, you can do?
Well, there's 5,000 brands that come to market every year. 10% of them make it to 100,000 in sales. 10% of those will make it maybe to $1 million in sales. And once in a while, there's lightning in a bottle that makes it to $1 billion in sales. The Alani Nu portfolio is on its way.
So it's more of a sure bet.
It's a sure bet. To build a loyal consumer base is practically near impossible. There is a extremely loyal consumer base behind the Alani portfolio and the Celsius portfolio, and it differentiates us, and it provides Celsius Holdings with a modern energy portfolio.
And I mean, let's marry this conversation into the competitive landscape because, like you said, there's plenty of competition, 5,000 brands coming to market every year. You think about Keurig Dr. Pepper, for example. They want a larger share of the energy drink market. They put some money behind buying Ghost back in October. And it seems like your answer, at least through this acquisition, has been to buy your way there. But Is it also a marketing challenge? Are you putting more money behind marketing to sort of keep and grow your slice of the pie?
Well, both our brands, Celsius and Alani, will be separate within the marketing, so it's very important to keep that brand identity. But what these brands do is offer together will be approximately a 16 share in the energy category. So Celsius goes from a number 3 player to a major number 3 player, and that comes with a lot of competitive advantages as well, dealing with retailers, supplier agreements, leverage, just running greater volume through the system. So we feel there's a lot of different levers that we're able to pull together, and that's why Alani and the founders, that's why we joined together. Mm-hmm. We joined together because we're going to be stronger together than going separate.
John, before we let you go, we have to talk about the share price because you almost became sort of this meme moment. You flew so high, reaching really impressive heights over the 5-year basis. I think you hit an all-time high in 2024, if we could bring up the shares. You've fallen sharply since, as we mentioned in the intro. I mean, what part of the story do you think that investors are missing? What message would you leave?
Well, when you look at it, the stock's been very volatile. When you saw the peak, we did have a downturn in the energy category for the first time. In Q3 of 2024, it went negative in growth, and it hasn't seen that in years. We do expect the category to continue to grow, get back to growth. Health and wellness trends continue to get stronger, better for you. The sugar movement is real. You can see it in the data. And Celsius and now Alani with the addition puts us in the best position to win within the energy category. So this drives shareholder value. You can see the leadership team, the board of directors are focused on that to leverage the infrastructure, drive more revenue and profits. And this transaction with Alani drives accretive to revenue and EPS in year 1.
Very cool to hear from a CEO of a successful brand how you're doing it, John. Great to have you here on set. John Fieldly there, the CEO of Celsius. We're going to continue to talk about the moves in NVIDIA and the drop it's driving in the market. This is Bloomberg.
Welcome back to Open Interest. Let's get a check on these markets right now. The S&P 500 intraday managed to fight its way back into the green, currently higher by about 0.3%. Can't say the same for big tech, and that's what you would expect with NVIDIA shares currently lower by about 2.5%, weighing on big tech with the NASDAQ 100 down about 0.2%. That bond market sell-off really building right now. The 10-year Treasury yield higher by about 4 basis points.
Oh.
Let's go back.
Almost 4 basis points.
I know. Don't freak out. Let's freak out about NVIDIA, though, because NVIDIA, the reaction has been really interesting. A total reversal of what we saw pre-market, now down about 2.7%. I'm glad we had Mandeep Singh on from Bloomberg Intelligence to remind us about that headline that we got at the top of the show about those tariffs on Canada, China, and Mexico going into effect on March 4th, additional tariffs for China. And the chip-making industry, and NVIDIA in particular, has really been in the crosshairs of those tensions that we've seen between China and the U.S.
Yeah, absolutely. I mean, another 10% on top of the 10% we got in February, on top of the tariffs that already existed there. It's got to, at some point, start to really affect the margins even more than it already has.
Right.
And if they're not going to beat and raise to the same level that they were previously, you're going to see a slowdown in the acceleration of the stock.
And as Mandeep,
this is quite cool. This is quite a cool.
Well, let me just make my point. As Mandeep said, that's not factored into the guidance. You know, we were already not impressed with guidance, and you think about those tariffs, as that beautiful chart is showing, not being factored in, things could get a little bit hairy.
Right. Mexico here in blue, Canada in white, and China in red. This shows you the breakdown in U.S. imports per month, $120 billion. So obviously 25, and 20 is going to hit pretty substantially. Coming up, we're going to talk about Norwegian Cruise Line signaling strong demand, but the Trump administration may be targeting the industry for more taxes. We'll talk to the CEO of Norwegian, Sommer. All right, another stock we're watching today is Norwegian Cruise Lines. It is in the red here. We can see with the rest of the market, Norwegian is falling, but it did put out an earnings report signaling strong cruise demand despite missing profit outlook expectations. Norwegian was one of a few cruise stocks that sank earlier this month as well, following comments from Commerce Secretary Howard Lutnick about a potential tax crackdown on ships that sail under foreign flags. Joining us now is the CEO, Harry Sommer, Norwegian Cruise Lines. Harry, came out with some numbers that looked on the one hand good, but missed maybe outlook expectations. Why don't you run us through the reasons for that first?
So thanks for having us on this morning. Appreciate it. So, we're really happy with our 2024 earnings scorecard. We had 10% yield increases to record numbers. It's a record percent increase, a record total yield. We had record EBITDA. We kept cost growth down to 1%. So like a 900 basis point spread between revenue growth and cost growth is fantastic. We had something like tripled our net income from 23 to 24. We reduced our leverage by 2 turns, increased our return on invested capital by 3 turns. So overall, we were really, really excited about our 24 paper, so to speak. Listen, 25 is going to be a little bit different, but we think it returns back to a normal cadence where, like in the back, like 3.5% yield growth or 3% yield growth on a half point growth in cost. So about a 300 basis point spread there,
right,
which we're really excited. Q1 has a couple of technical issues that are dragging it down related to a few of our big ships going to for some long dry docks. But absent that, we're really happy about the future as well.
Well, in addition to booking and the momentum that you're seeing in bookings, I also want to talk about how much people are actually spending when they're on board. Of course, that's a big way how cruises such as yourself make money. And with this fear that we're seeing over inflation, the concerns that are building about the consumer, do you anticipate that people riding aboard your cruises are going to pull back on their spending once they're actually on the ship?
No, we don't see that. The onboard spend, which we track, as you might imagine, on a weekly basis, was strong both for Q4 and our reported numbers and continues to be strong throughout January and now February as well. That's the month's almost over. We're very, very pleased. I think within the core demographic that we're getting, which is primarily, upper middle class and upper class guests for our 2 luxury brands, Oceania Cruises and Regent 7 Sea Cruises, they seem to be doing well despite the modest inflationary environment we're seeing today. So we are not seeing any cracks in onboard spend.
I wonder if you factor in any additional tax bills you might receive from the Trump administration. As we noted in the intro, Howard Lutnick was, I guess, unhappy that a lot of cruise liners and oil tankers are sailing around with, low tax Caribbean flags on the back. Most of your fleet is out of the Bahamas. What do you say about that, or what would you do about it? Could you imagine putting more American flags on your boats?
So, I'll start off by saying it's a bit of a misnomer that the cruise industry doesn't pay tax. As an industry, our trade association puts out some statistics. I think as an industry, we pay close to $2.5 billion in taxes on an annual basis to various U.S. jurisdictions. We just pay them in different forms. It's not an income tax, they're port taxes, but essentially it gets to the same thing. It gets to the treasury of local and state and some federal taxes as well. So that's a pretty robust tax bill. Now, of course, the administration may choose to pursue additional taxes on the industry. So it's a relatively complicated situation as our ships aren't based in the United States for long periods of time. So a little bit difficult to ascertain exactly what our tax bill would be, depending on how they may want to modify the tax code. But I will say, we're genuinely pleased with some of the other actions of the administration. This pursuit of peace in the Middle East and between Russia and Ukraine, which hopefully comes to fruition over the next few months, would be a major tailwind to us. We have one of our highest yielding itineraries, back in the day, 17, 18, and 19, were cruises that visited Russia, most specifically St. Petersburg. We have about a third of our fleet based in Northern Europe across our 3 brands in the summer. And to the extent that Russia opened up, this could be a significant tailwind to us in order to start visiting St. Petersburg. It was one of our most lucrative and, more importantly, highest rated ports from a guest experience perspective.
That's really interesting, Harry, to hear you say that. I know that your results last year were hurt in particular by the conflict in Israel and specifically in the Red Sea. So talk to us a little bit more about the potential opportunity that you could see, though, in Russia? Because, I mean, at least listening to your preliminary comments now, it seems like you're saying that is a big opportunity.
Yes, I mean, this industry thrives in peaceful environments, as you may imagine. Guests don't want to take vacations in areas of conflict. And I don't mean to state the obvious, but I think it's important to note. And if we can get some relative calm in the situation, especially in Russia, like I said, with 11 of our ships, about a third of our fleet based up there, we can certainly make some, it starts with the guest experience. If we can provide guests with a even better experience than they get today, we can generate additional revenue and therefore profit. The Middle East is a little bit more complicated because it's a little bit more of a long lead time. There's slightly more exotic cruises that go to that part of the world. But assuming things continue to calm down in that region, we think there could be a tailwind for our 2027 results. So I think both those areas are key. And we're again, very pleased with the work that the administration is doing in those areas.
So I know it's early and, you're thinking about this as maybe a 2027 story, but is there any range of numbers that you could put to that opportunity?
It's really hard to tell. It depends when it happens, how far in advance. But, with 11 ships in that Northern Europe region, even a $10 or $20 per diem impact on those cruises could be significant. But because that was the type of impact we got back in 17 to 19 on a positive basis. So it could be meaningful to the bottom line.
All right, Harry, really appreciate you taking the time to speak with us today after what I'm sure is a very busy morning. Our thanks to Harry Sommer of Norwegian Cruise Lines. Now let's get a quick check on these markets right now. We're about an hour and then some into the trade. Still lower when it comes to the NASDAQ 100. Those losses deepening once again. On your big benchmark, the S&P 500, we're pretty much flat, just about unchanged on the day. We are continuing to watch the wiggling that's going on in NVIDIA right now. Some of those trade tensions, those tariff fears really weighing on the stock after a pretty ho-hum earnings report. NVIDIA shares currently off by about 3%. We'll continue to follow the markets next. This is Bloomberg. All right, it's time now for our Wall Street Week conversation. And the number of bankrupt companies in the U.S. is on the rise, up over 70% in the past 2 years alone. But that doesn't always mean the end for a business. Bloomberg Wall Street Week host David Weston explores the life cycle of zombie companies.
A zombie company, it's fundamentally a financially unsustainable company. These are companies that are not producing enough operating profit to pay the interest on their loans. And they've been in that position for at least 3 consecutive years. So when we talk about a zombie, it's not a company that had a bad year or a startup or anything like that. We're talking about sustained material underperformance. These are publicly traded companies that have been in business for at least 10 years, that have revenue for each of those 10 years. These are real companies that are having profound financial issues.
Vincenzo Spazzato is a partner at Carney, writing a yearly report on zombie companies and their effect on the health of the overall economy.
You study these zombie companies. How many are there?
Just looking back to put this in perspective, in 2010, there were under 2% of publicly traded companies globally. We've seen around 10% annual growth since then. And so we're up to around 6% of all publicly traded companies globally. 6 out of 100 are currently zombies. So we're talking about a not insignificant number of companies. It's sort of all industries, all company sizes. They're sort of everywhere.
In 2023 alone, Carney identified 827 new zombie companies, taking the total number to almost 2,500 globally, with real estate and manufacturing leading the way.
A lot of zombies are companies that should not have gotten financing to begin with. Given the sort of easy access to capital that we saw coming out of 2008 and the financial crisis, and those are companies that are going to be very difficult to turn around.
Normally, we'd think those companies get weeded out.
You would think so, and yet a lot of times they'll carry that interest forward. The interest payable is a loss. Capital markets are incredibly rewarding and have been very forgiving recently, particularly coming out of the financial crisis. There's been just real easy access to financing to a lot of companies that one may argue shouldn't have actually receive that financing at such low interest rates that they were able to sort of kick the can on the issue and move things forward. So a lot of zombies have, in fact, stayed in business for a long time. Many of them do ultimately. They either go bankrupt, they get acquired, or every once in a while they're able to turn themselves around.
One of those so-called zombie companies that's come back from the dead is the well-known bookseller Barnes & Noble. Back in 2010, it teetered on the brink, closing hundreds of stores and laying off thousands of workers. And then in 2018 became a full-blown zombie.
We've definitely seen an increase in the number of people coming through the door. That sense of discovery, it's a different experience, to go from table to table or bay to bay and find something new.
And that was Wall Street Week host David Weston. You can catch the full show every Friday at 6 p.m. Eastern. Quick check here on NVIDIA shares, now down about 3%. We know that guidance left something to be desired last night. We're also worried about margins. We're also worried about tariffs. All of that working its way through shares right now, currently off about 3%. We'll continue to follow that one. But coming up next, we're live from Ares' offices in New York for an exclusive interview with the company's CEO, Mike Arougheti. That's up next. This is Bloomberg.
You're watching Open Interest. I'm Sonali Basak. I'm sitting here with Ares Management CEO Michael Arougheti. And it's interesting, Mike, good to see you today.
Great to see you. Thanks for coming down.
Oh, you're welcome. This is on the heels of some news at Ares.
Yes.
This is on the heels of a big set of promotions. You announced co-presidents for the firm, but that also set off a wave of promotions underneath them as well. What does this mean for the future of Ares and the direction you're trying to go?
I'm so happy. So Kip DeVere and Blair Jacobson, who I think you're sitting down with later, are two of my oldest friends. We've been friends for 30 years, business partners for 25 years in the case of Kip, 15 plus years in the case of Blair. So anytime you can elevate, good quality people, it's cause for celebration. But as you hinted at, we've been, I think, really good at succession. Private equity firms historically are great at succession, I think, within their portfolios, but when it comes to themselves have sometimes missed the mark. And I think any good, high-quality growth company needs to be great at succession and needs to create pathways for growth for future leaders. So the reality is over the last year, we've elevated co-heads in our European direct lending business. We've elevated co-heads in our U.S. direct lending business. We've elevated people in real estate. And there's just been this massive, wave of growth and promotion. I think part of what makes our culture unique, speaking to the friendship that I have with Blair and Kip, but it pervades the whole organization, is we have people here who are now running businesses that started at Ares 20, 25 years ago as analysts and really grew up in this culture. So I just couldn't be happier.
It's interesting. This is not just happening at Ares. It's kind of happening across the street where you're seeing more people in high-level roles being tapped to be elevated to the number 2, 3, 4 positions. What does this say about the talent war on Wall Street? What are you seeing when you talk to the banks and you talk to your rivals about people who might want to come here?
Look, I think you win in this game by developing and retaining great talent. I think we've been fortunate. We have very, very low turnover, and you can see that in the way that our, leaders are growing and developing here. There's always going to be a war for talent. I think the reality is the large firms in our business are getting larger. There's huge benefits to size and scale. So I'd like to think that we and others are kind of net beneficiaries of that war for talent. I would imagine certain other parts of the market, whether some of the investment and commercial banks are, probably struggling to maintain talent, just given some of the secular changes that are happening in our market.
To that end, few people realize that you added about 100 investment professionals last year.
We did. So we grew our investment teams over 10% last year, and we just came out of our planning meetings for this year, and I would expect growth this year will be similar. So obviously the businesses are growing, they're diversifying, they're globalizing, and the way you support that growth and complexity is, adding high quality talent.
100 more people.
Yeah, well, we're up to almost 4,000 people now, obviously. So that's part of the conversation around the elevation of Kip and Blair is obviously just putting some of our most proven business builders and leaders against this growth and complexity.
The growth is coming against an interesting backdrop. I was looking at the 10-year yield from the beginning of the year to now, and the drop-off is pretty stunning. Yeah. You are more than a half a percentage point from the highs that you saw just in January. Yep. The market is afraid of growth. Mm-hmm. Are you?
We're not, and if you look, consumer confidence is feeling a little wobbly. CEO confidence is not showing the same anxiety. Obviously one of the benefits of running the business that we run is we see things happening in the real economy all over the globe, and we're just not seeing the deceleration in growth. So our base case coming into the year was that you'd continue to see, solid fundamental growth. You'd see persistently high prices and inflation. Labor markets are still very tight. So it's interesting when you think about public markets versus private markets. The public markets can get a little schizophrenic day to day, week to week, and I think in the private markets we try to keep a longer term view, and at least based on what we're seeing, we haven't changed our view.
But what are you preparing for more at this point, for interest rates to be higher or lower from here?
I'm still in the camp of stable to higher for longer than changing our view that we're going to see increasing cuts throughout the end of the year.
We are still seeing a number of bankruptcy filings come to market. We are seeing some signs of stress, given we're in this higher for longer environment. What are you seeing out there? Are there places in the market that you're avoiding right now because of it?
There's all the way that we've set the business up. It's interesting. If you look at our history, we've grown at almost a 25% growth rate over the last 20 plus years. We've grown fastest coming out of the financial crisis and coming out of COVID. So the way that the business is designed, just based on the products that we have, is to be a liquidity provider in good markets and challenged markets. So coming into any given year, we don't have anxiety about the ability to deploy. It's just a question of where is that deployment going to come from? Obviously, in the more interest rate sensitive sectors that we invest in, like real estate, will show signs of stress. Low-end consumer lending will show signs of stress. But when you look at it indexed across everything we do, it's, still, we expect it's going to be a good year.
So let's talk again about Ares' growth strategy for a moment here, because what's been so notable is that you've made a recent multi-billion-dollar acquisition, and the industry has been consolidating. Do you see more acquisitions in your near future?
I think acquisitions are always going to be part of our growth. The bar for acquisitions is getting higher and higher as we fill out our, our bingo card, if you will, in terms of capabilities and geographies. But consolidation in our industry will absolutely continue. If you look at the benefits of scale in this industry in terms of capital raising, capital deployment, talent acquisition and retention, the bigger getting bigger for good reason, and size is actually showing up in performance. So unlike public markets where people get concerned that the bigger you get, the harder it is to perform, I think we and the large publics are showing that as we consolidate and accumulate capability, information edge, that we're actually outperforming. And so I think you're going to continue to see people fill out capability, geography, distribution in this, in this phase of growth.
Speaking of distribution, you're seeing some interesting partnerships starting to come together in the market, and a lot of it is for the idea of bringing private capital, particularly private credit, into the hands of retail investors. Mm-hmm. Just today, you saw the launch of that Apollo State Street Private Credit ETF. Would you start an ETF?
Well, I always try to remind people there's a big difference between investment grade private credit and what the market generally thinks of as private credit. And those are offering different types of exposures, and they have opportunity for different types of distribution with both retail and institutional investors. So that's point number one. Point number two is if you look at Ares as an example, we run a BDC called Ares Capital Corporation. We have a 20-year track record and an almost $30 billion portfolio of private loans, private credit, that has daily liquidity and is available to any retail investor around the globe. We also have a large interval fund that invests in a diverse, array of high grade and below investment grade credit exposures. It offers liquidity. So I think these are more evolutionary moves, but I think it's important that people understand this is not a huge transformation. There's already technology that exists that's well understood, well trodden, well bought, and has performed well, where retail investors can get access to private credit and other private market assets.
So I'm told I have one more question
Yes.
with you, although I have many on the ETF. I'll have your co-presidents later. Got to ask you about the NFL.
Yes.
You really were involved in the first deal that went to the hands of private equity, the Miami Dolphins.
Yes.
What's the next team?
You know, I can't tell you what we're going to do next, but this NFL opening up to private capital, I think, is so indicative of just the role that private markets and private capital plays generally in the opening up of new markets, right? So if you just think about sports investing and the NFL, 5 years ago, institutional capital was not actually able to access the NFL or the other major sports leagues around the globe. And post-COVID now, we've innovated to bring creative capital solutions into these markets and created just a whole new market. And now we're offering those exposures to institutional and retail investors. So I think this is a recurring theme of how private markets can actually come in with flexibility, creativity, liquidity, where other traditional forms of capital can, to really do something special.
It certainly brought me into the world of sports reporting much more.
Good,
Mike,
I'm glad.
we thank you so much for your time. That is Michael Arougheti, of course, the CEO of Ares Management. Katie, back to you.
All right, our big thanks to Sonali Basak for bringing us that exclusive conversation. And as she mentioned, she will also be speaking with the new co-presidents of Ares later today. That's
By the way,
at
this
12:30 p.m.
This is not what she needs. More sports betting momentum.
Yeah,
fuel.
That's true. Reporting is good. Betting, let's be careful there.
Coming up next on Bloomberg Technology, we have an interview with Amazon CEO Andy Jassy. So Carolyn Hyde is going to dive into those NVIDIA numbers for you, give you the market reaction as they drop, and then talk to the CEO of Amazon, Andy Jassy. This is Bloomberg.